Hey there, everyone. Welcome back to our channel. If you're new here, don't forget to hit that subscribe button and give us a big thumbs up if you enjoy this video. Today, we have something incredibly special for you. A deep dive into the book, Millennial Money Mastery. In this video, we'll explore how you can take control of your finances and build a prosperous future, tailored especially for the younger generation. Whether you're just starting out in your career or looking to get a better handle on your money, this book has got you covered. And guess what? You don't have to wait to start learning. We've put together a comprehensive summary of Millennial Money Mastery, just for you, and it's completely free. You can download it right now by clicking the link in the description below. So, make sure to like this video, subscribe to our channel for more amazing content, and share it with anyone who could use some financial wisdom. Let's dive in and unlock the secrets to mastering your money. Millennial Money Mastery, Financial Tips for the Next Generation. By MindBloom Audiobooks. Introduction: Navigating the Financial Landscape. Navigating the financial landscape as a millennial can feel overwhelming. From student loans to the high cost of living, the challenges are numerous. However, the opportunities to build a secure financial future are also abundant. This book aims to provide you with the tools and knowledge needed to master your finances and achieve financial independence. In this introduction, we'll explore the unique financial challenges and opportunities that millennials face. We'll discuss the importance of financial literacy and how understanding the basics of money management can set you on the path to financial success. By the end of this book, you'll have a comprehensive understanding of how to manage your money effectively, invest wisely, and build a secure financial future. The financial landscape has changed dramatically over the past few decades. With the rise of technology, the gig economy, and new financial products, millennials have more options than ever before. However, these changes also come with new risks and complexities. Understanding how to navigate this landscape is crucial for achieving financial success. Financial literacy is the foundation of financial independence. It involves understanding key concepts such as budgeting, saving, investing, and debt management. Unfortunately, many millennials did not receive adequate financial education in school, leaving them ill-prepared to handle their finances. This book aims to fill that gap by providing practical, actionable advice on all aspects of money management. One of the most significant financial challenges millennials face is student loan debt. With the cost of higher education continuing to rise, many young adults are graduating with substantial debt. Managing this debt effectively is crucial for achieving financial stability. We'll explore strategies for repaying student loans, managing debt, and building a strong financial foundation. Budgeting is another essential skill for financial success. Creating a budget helps you understand where your money is going, identify areas for savings, and ensure you're living within your means. We'll discuss practical budgeting techniques tailored to the unique financial situations of millennials. Saving is another critical component of financial health. Whether you're saving for an emergency fund, a major purchase, or your future retirement, having a solid savings plan is essential. We'll explore different saving strategies and tips for building and maintaining a healthy savings habit. Investing is a powerful tool for building wealth over time. By starting to invest early, you can take advantage of compound interest and grow your money significantly. We'll cover the basics of investing, different types of investments, and strategies for creating a diversified portfolio. Building good credit and managing debt are also crucial for financial success. Your credit score affects your ability to borrow money, rent an apartment, and even get a job. We'll discuss strategies for building and maintaining good credit, managing debt, and avoiding common financial pitfalls. Financial literacy isn't just about managing money, it's also about understanding the broader economic landscape. We'll explore the importance of continuous learning and staying informed about financial trends and changes. By staying educated, you can make informed decisions and adapt to economic changes. Finally, we'll share real-life success stories from millennials who have achieved financial independence. These stories will provide inspiration and practical insights into how you can apply the principles discussed in this book to your own life. By the end of this book, you'll have the knowledge and tools needed to master your finances and achieve financial independence. You'll understand how to navigate the financial landscape, manage your money effectively, and build a secure financial future. Let's embark on this journey to millennial money mastery together. Chapter 1: Understanding your financial situation. Before you can take control of your finances, it's essential to understand your current financial situation. This involves taking a detailed look at your income, expenses, assets, and liabilities. By understanding where you stand financially, you can identify areas for improvement and set realistic financial goals. Start by calculating your net worth. Your net worth is the difference between your assets, what you own, and your liabilities, what you owe. Assets can include cash, savings, investments, property, and valuable possessions. Liabilities include debts such as student loans, credit card balances, car loans, and mortgages. Subtract your total liabilities from your total assets to determine your net worth. This number provides a snapshot of your financial health. Next, review your income and expenses. Track all sources of income, including your salary, side hustles, and any other money you receive. Then, list all your expenses, including rent or mortgage payments, utilities, groceries, transportation, insurance, entertainment, and other discretionary spending. By tracking your income and expenses, you can create a budget and identify areas where you can cut costs or increase savings. Understanding your spending habits is also crucial. Review your bank statements and credit card bills to see where your money is going. Are there any areas where you're overspending? Are there subscriptions or memberships you no longer use? Identifying unnecessary expenses can help you free up money to save or invest. If you have debt, it's important to understand the details of each loan or credit account. Know the interest rates, minimum payments, and repayment terms for each debt. This information will help you prioritize which debts to pay off first and create a debt repayment plan. Once you have a clear picture of your financial situation, you can set realistic financial goals. These goals should be specific, measurable, achievable, relevant, and time-bound, SMART. For example, a goal might be to pay off $5,000 in credit card debt within 2 years or to save $10,000 for an emergency fund within 18 months. Setting financial goals gives you direction and motivation. Break down your goals into smaller, manageable steps and track your progress regularly. Celebrate your achievements along the way to stay motivated and committed to your financial journey. In addition to setting goals, it's important to create a financial plan. Your financial plan should outline how you will achieve your goals, including specific actions and timelines. This plan should be flexible and adaptable to changes in your life or financial situation. Review and update your financial plan regularly to ensure you're on track to meet your goals. Building a strong financial foundation requires discipline and commitment. It's important to develop good financial habits, such as saving regularly, avoiding unnecessary debt, and living within your means. These habits will help you build wealth over time and achieve financial independence. Understanding your financial situation is the first step towards taking control of your finances and achieving your goals. By knowing where you stand financially, setting realistic goals, and creating a financial plan, you can build a secure financial future and master your money. Chapter 2: Overcoming Student Loan Debt. Student loan debt is one of the most significant financial challenges facing millennials today. With the rising cost of higher education, many young adults are graduating with substantial debt that can take years, even decades, to repay. However, with the right strategies and mindset, you can manage and overcome this debt effectively. Understanding the specifics of your student loans is the first step in tackling them. Start by gathering all your loan information, including the types of loans, federal or private, interest rates, outstanding balances, and repayment terms. Knowing these details will help you create a repayment plan that fits your financial situation. Federal student loans often come with various repayment options, including standard, graduated, and income-driven plans. Standard repayment plans have fixed monthly payments over 10 years, while graduated plans start with lower payments that increase over time. Income-driven repayment plans adjust your monthly payments based on your income and family size, which can make payments more manageable if you're earning a lower income. If you have private student loans, the repayment options may be more limited, and interest rates can vary widely. It's essential to review the terms of your private loans and explore any available options for refinancing or consolidating them to secure a lower interest rate and reduce your monthly payments. One effective strategy for managing student loan debt is to make extra payments whenever possible. By paying more than the minimum payment each month, you can reduce the principal balance faster and save on interest over the life of the loan. Even small additional payments can make a significant difference over time. Another approach is to prioritize paying off high-interest loans first. By focusing on the loans with the highest interest rates, you can reduce the amount of interest you pay overall and free up more money to pay down other debts. This strategy is often referred to as the avalanche method. If you're struggling to make your student loan payments, consider exploring deferment or forbearance options. Deferment allows you to temporarily pause your loan payments without accruing interest on federal subsidized loans. Forbearance also pauses your payments but may still accrue interest. These options can provide temporary relief during financial hardships but should be used cautiously, as they can extend the repayment period and increase the total cost of the loan. Public Service Loan Forgiveness, PSLF, is another option for those working in qualifying public service jobs. After making 120 qualifying monthly payments under a qualifying repayment plan, the remaining balance on your federal student loans may be forgiven. This program can be an excellent option for those committed to careers in public service, such as education, healthcare, or government. Refinancing your student loans can also be a viable option if you have a stable income and good credit. Refinancing involves taking out a new loan with a private lender to pay off your existing loans. This can potentially lower your interest rate and monthly payments, but it may also result in losing certain federal loan benefits, such as income-driven repayment plans and loan forgiveness programs. In addition to these strategies, it's crucial to maintain a disciplined approach to managing your finances. Create a budget that prioritizes your student loan payments, and look for ways to reduce expenses and increase your income. Side hustles, freelance work, or part-time jobs can provide additional income to put towards your loans. Building an emergency fund is also essential. Having savings set aside for unexpected expenses can prevent you from falling behind on your loan payments during financial setbacks. Aim to save at least 3 to 6 months' worth of living expenses in a separate, easily accessible account. Remember, overcoming student loan debt is a marathon, not a sprint. It requires patience, discipline, and a long-term commitment to financial health. By understanding your loans, exploring repayment options, making extra payments, and maintaining a budget, you can take control of your debt and work towards financial freedom. In summary, managing and overcoming student loan debt involves understanding your loan details, exploring repayment options, making extra payments, prioritizing high-interest loans, considering deferment or forbearance, exploring loan forgiveness programs, refinancing if beneficial, maintaining a disciplined budget, and building an emergency fund. With the right strategies and mindset, you can overcome the burden of student loan debt and build a secure financial future. Chapter 3: Budgeting for Millennials. Creating and maintaining a budget is a fundamental aspect of financial management. For millennials, budgeting can help navigate the unique financial challenges of this generation, such as student loan debt, high living costs, and economic uncertainty. A well-crafted budget provides a clear picture of your income and expenses, helping you make informed financial decisions and achieve your goals. The first step in creating a budget is to track your income. List all sources of income, including your salary, freelance work, side hustles, and any other money you receive. Having a comprehensive understanding of your income is essential for effective budgeting. Next, track your expenses. This includes both fixed expenses, such as rent or mortgage payments, utilities, and insurance, and variable expenses, such as groceries, dining out, entertainment, and transportation. Categorize your expenses to see where your money is going and identify areas where you can cut costs. Once you have a clear picture of your income and expenses, it's time to create a budget. Start by prioritizing your essential expenses, such as housing, utilities, groceries, and transportation. These are non-negotiable and must be covered each month. After accounting for your essential expenses, allocate funds for your financial goals. This includes paying off debt, saving for an emergency fund, contributing to retirement accounts, and investing. Prioritizing these goals helps ensure you're building a strong financial foundation. Finally, allocate funds for discretionary spending, such as dining out, entertainment, and hobbies. While it's important to enjoy life, discretionary spending should not come at the expense of your financial goals. Look for ways to reduce these expenses without sacrificing your quality of life. Using the 50-30-20 budgeting rule can be a helpful guideline. This rule suggests allocating 50% of your income to essential expenses, 30% to discretionary spending, and 20% to savings and debt repayment. Adjust these percentages based on your financial situation and goals. Budgeting tools and apps can simplify the process and help you stay on track. Apps like Mint, YNAB, You Need a Budget, and Personal Capital offer features such as expense tracking, goal setting, and financial insights. Choose a tool that fits your needs and preferences. Reviewing and adjusting your budget regularly is crucial. Life circumstances and financial situations change, and your budget should reflect these changes. Set aside time each month to review your income and expenses, track your progress towards your goals, and make any necessary adjustments. In addition to creating a budget, developing good financial habits is essential. This includes avoiding unnecessary debt, living within your means, and making conscious spending decisions. Building these habits early can set you on the path to long-term financial success. Budgeting for millennials involves tracking income and expenses, prioritizing essential expenses, allocating funds for financial goals, managing discretionary spending, using budgeting tools, and developing good financial habits. By creating and maintaining a budget, you can take control of your finances, achieve your goals, and build a secure financial future. Chapter 4: Saving Strategies for Young Adults. Saving money can feel like a daunting task, especially when you're just starting out. But building good saving habits early on can set you up for long-term financial success. Let's dive into some practical and easy-to-understand strategies that can help you save money effectively. First, let's talk about the importance of an emergency fund. An emergency fund is money set aside for unexpected expenses, like car repairs, medical bills, or sudden job loss. Having this fund can give you peace of mind and prevent you from going into debt when surprises happen. Aim to save at least 3 to 6 months' worth of living expenses in your emergency fund. Start small if you need to, but make it a priority to build this safety net. One of the best ways to save money is to make it automatic. Set up an automatic transfer from your checking account to your savings account each month. This way, you won't have to remember to save, and you'll be less tempted to spend that money. Even if it's just a small amount, automatic saving can add up over time. Another effective strategy is to take advantage of any employer-sponsored retirement plans, like a 401k. If your employer offers a match on your contributions, try to contribute enough to get the full match. This is essentially free money and can significantly boost your savings over time. If you're self-employed or your employer doesn't offer a retirement plan, consider opening an individual retirement account, IRA, and contributing regularly. Cutting back on non-essential expenses can also free up money to save. Take a close look at your spending habits and identify areas where you can cut back. Do you eat out frequently? Consider cooking more meals at home. Do you have subscriptions or memberships you don't use? Cancel them. Small changes in your spending can make a big difference in your ability to save. Consider using budgeting apps or tools to help you track your expenses and identify areas for savings. Apps like Mint, YNAB, You Need a Budget, and Pocket Guard can help you stay on top of your finances and find opportunities to save more. Another great way to save money is to take advantage of discounts and rewards programs. Look for student discounts, cashback offers, and loyalty programs that can help you save on everyday purchases. Using these programs wisely can help you keep more money in your pocket. When it comes to saving, it's also important to set specific goals. Having clear, achievable goals can motivate you to save more. Whether you're saving for a vacation, a new gadget, or a down payment on a house, knowing what you're working towards can help you stay focused and disciplined. Remember, saving money is a journey, not a sprint. It's okay to start small and gradually increase your savings over time. The key is to be consistent and make saving a habit. By following these strategies and staying committed to your goals, you can build a strong financial foundation and achieve financial success. Chapter 5: Smart Spending: Making Your Money Work for You. Smart spending is all about making conscious decisions with your money. It's not about depriving yourself of things you enjoy, but rather about finding a balance between spending and saving that allows you to live comfortably while also working towards your financial goals. One of the first steps to smart spending is understanding the difference between needs and wants. Needs are essential expenses, like rent, groceries, and utilities. Wants are things that are nice to have but aren't necessary, like dining out, entertainment, and luxury items. By prioritizing your needs and being mindful of your wants, you can make more informed spending decisions. Creating a budget can help you track your spending and ensure you're living within your means. Start by listing all your monthly income and expenses. Categorize your expenses into needs and wants, and allocate a portion of your income to each category. Make sure to include savings and debt repayment in your budget as well. Stick to your budget as closely as possible and adjust it as needed. Another key aspect of smart spending is avoiding lifestyle inflation. Lifestyle inflation happens when your spending increases as your income increases. While it's natural to want to enjoy the fruits of your labor, it's important to keep your spending in check and avoid unnecessary expenses. Instead of spending more as you earn more, focus on saving and investing the extra income to build wealth over time. Look for ways to save money on everyday expenses. For example, you can save on groceries by shopping sales, using coupons, and buying generic brands. You can save on transportation by using public transit, carpooling, or biking instead of driving. Find areas where you can cut costs without sacrificing your quality of life. Consider adopting a minimalist mindset when it comes to spending. Minimalism is about valuing experiences and relationships over material possessions. By focusing on what truly matters to you and eliminating unnecessary clutter, you can simplify your life and save money. Before making a purchase, ask yourself if it aligns with your values and if it will truly bring you joy. Another effective strategy is to set spending limits for discretionary expenses. For example, you might allocate a certain amount of money each month for dining out or entertainment. Once you've reached your limit, avoid spending any more in that category until the next month. This can help you stay within your budget and avoid overspending. Using cash instead of credit can also help you control your spending. When you use cash, you're more aware of how much you're spending and are less likely to make impulsive purchases. Consider using the envelope system, where you allocate cash for different spending categories and only use that cash for those expenses. Finally, be mindful of your long-term financial goals. Every spending decision you make should align with your overall financial plan. Whether you're saving for a big purchase, paying off debt, or investing for the future, keeping your goals in mind can help you make smarter spending choices. Smart spending is about being intentional with your money and making choices that support your financial well-being. By understanding your needs and wants, creating a budget, avoiding lifestyle inflation, and adopting a minimalist mindset, you can make your money work for you and achieve financial success. Chapter 6: Debt Management: Conquering Your Financial Foes. Debt can be a major obstacle to financial success, but with the right strategies, you can manage and eliminate it. Understanding the different types of debt and how to prioritize repayment is crucial for conquering your financial foes. First, let's differentiate between good debt and bad debt. Good debt is an investment that can help you build wealth over time, such as a mortgage or student loans. These types of debt often have lower interest rates and can lead to long-term financial benefits. Bad debt, on the other hand, includes high-interest debt like credit card balances and payday loans. This type of debt can quickly become overwhelming and should be prioritized for repayment. To manage your debt effectively, start by listing all your debts, including the outstanding balances, interest rates, and minimum monthly payments. This will give you a clear picture of your debt situation and help you create a repayment plan. One popular debt repayment strategy is the debt snowball method. With this approach, you focus on paying off your smallest debt first while making minimum payments on your other debts. Once the smallest debt is paid off, you move on to the next smallest debt, and so on. The idea is that the psychological boost of paying off debts quickly will keep you motivated. Another strategy is the debt avalanche method. With this approach, you prioritize paying off your debt with the highest interest rate first while making minimum payments on your other debts. Once the highest interest debt is paid off, you move on to the next highest interest debt. This method can save you more money in interest payments over time. If you have multiple high-interest debts, consider consolidating them into a single loan with a lower interest rate. Debt consolidation can simplify your payments and reduce the overall interest you pay. However, be cautious of any fees associated with consolidation and ensure the new loan terms are favorable. Creating a budget is essential for managing debt. Allocate a portion of your income to debt repayment and look for ways to cut expenses and increase your payments. Avoid taking on new debt while you're working to pay off existing debt. This may require making lifestyle changes and being disciplined with your spending. Building an emergency fund is also crucial for debt management. An emergency fund can prevent you from relying on credit cards or loans in case of unexpected expenses. Aim to save at least 3 to 6 months' worth of living expenses in an easily accessible account. If you're struggling to make your debt payments, consider reaching out to your creditors to discuss your options. Many creditors offer hardship programs or may be willing to negotiate lower interest rates or payment plans. Seeking the help of a credit counselor can also provide guidance and support in managing your debt. In addition to these strategies, developing good financial habits can help you stay out of debt in the future. This includes living within your means, avoiding impulsive purchases, and prioritizing saving and investing. Building good credit by paying your bills on time and keeping your credit utilization low can also improve your financial health. Remember, managing and eliminating debt is a journey that requires patience and persistence. By understanding your debt, creating a repayment plan, and developing good financial habits, you can conquer your financial foes and achieve financial freedom. Chapter 7: Investing Early for Long-Term Gains. Investing early is one of the most powerful ways to build wealth over time. By starting to invest at a young age, you can take advantage of the power of compound interest, which allows your money to grow exponentially. In this chapter, we'll explore the basics of investing and provide practical tips to help you get started. First, let's talk about why investing is important. While saving money in a bank account is a good start, the interest rates on savings accounts are typically low. Investing your money can provide higher returns and help you achieve your financial goals more quickly. The key to successful investing is to start early, be consistent, and think long-term. One of the simplest ways to start investing is through a retirement account, such as a 401k or an individual retirement account, IRA. These accounts offer tax advantages that can help your money grow faster. If your employer offers a 401k with a matching contribution, try to contribute enough to get the full match. This is essentially free money that can significantly boost your retirement savings. When it comes to choosing investments, it's important to diversify your portfolio. Diversification means spreading your money across different types of investments to reduce risk. A well-diversified portfolio might include a mix of stocks, bonds, mutual funds, and exchange-traded funds, ETFs. Stocks represent ownership in a company and can provide high returns but come with higher risk. Bonds are loans to a company or government and offer lower returns but are generally safer. Mutual funds and ETFs pool money from many investors to buy a diversified mix of stocks and bonds. One popular strategy for beginners is to invest in index funds. Index funds are a type of mutual fund or ETF that aims to replicate the performance of a specific market index, such as the S&P 500. Because they track an entire index, they offer broad market exposure and tend to have lower fees than actively managed funds. It's also important to understand the concept of risk and return. Generally, investments with higher potential returns come with higher risk. Your risk tolerance depends on your financial goals, time horizon, and personal comfort level. If you're young and have a long time until you need the money, you can afford to take on more risk because you have time to ride out market fluctuations. As you get closer to your goals, you might want to shift to safer investments. One of the keys to successful investing is consistency. Make regular contributions to your investment accounts, even if it's just a small amount each month. This strategy, known as dollar cost averaging, can help you buy more shares when prices are low and fewer shares when prices are high, reducing the impact of market volatility. It's also important to avoid trying to time the market. Trying to predict market highs and lows is extremely difficult and can lead to costly mistakes. Instead, focus on a long-term strategy and stay invested through market ups and downs. Historical data shows that the stock market tends to go up over the long term, despite short-term fluctuations. Finally, take advantage of financial education resources to continue learning about investing. Books, online courses, and financial websites can provide valuable information and help you make informed decisions. Consider seeking advice from a financial advisor if you need personalized guidance. Investing early for long-term gains involves starting as soon as possible, diversifying your portfolio, understanding risk and return, being consistent, avoiding market timing, and continuing your financial education. By following these principles, you can build a strong investment portfolio and achieve your financial goals. Chapter 8: Building Passive Income Streams. Building passive income streams is an excellent way to increase your financial security and achieve financial independence. Passive income is money earned with little to no ongoing effort, allowing you to make money while you sleep. In this chapter, we'll explore various ways to create passive income and provide tips to help you get started. One of the most common sources of passive income is rental properties. Owning rental properties can provide a steady stream of income each month. However, being a landlord requires an initial investment of time and money to purchase and maintain the property. It's important to do your research, choose the right property, and manage it effectively to ensure a positive cash flow. Another popular source of passive income is dividend-paying stocks. Dividends are payments made by companies to their shareholders, typically on a quarterly basis. By investing in dividend-paying stocks, you can earn regular income in addition to any capital gains from the appreciation of the stock's value. Look for companies with a history of consistent and growing dividends. Peer-to-peer lending platforms offer another way to earn passive income. These platforms connect borrowers with investors, allowing you to lend money to individuals or small businesses in exchange for interest payments. While peer-to-peer lending can offer higher returns than traditional savings accounts, it's important to understand the risks involved and diversify your investments across multiple loans. Creating and selling digital products is another effective way to generate passive income. Digital products, such as e-books, online courses, and software, can be created once and sold repeatedly. Platforms like Amazon Kindle Direct Publishing, Udemy, and Etsy make it easy to reach a wide audience and generate sales. The key is to create high-quality content that provides value to your customers. Affiliate marketing is another popular passive income strategy. By promoting products or services from other companies, you can earn a commission on sales made through your referral links. Building a website, blog, or social media presence can help you attract an audience and generate affiliate income. Choose products that align with your interests and provide genuine value to your audience. Investing in real estate investment trusts, REITs, is another way to earn passive income from real estate without the hassle of managing properties. REITs are companies that own and operate income-generating real estate, such as apartment buildings, shopping centers, and office complexes. By investing in REITs, you can earn regular dividends and benefit from the appreciation of the underlying properties. Creating a high-yield savings account or a certificate of deposit, CD, can also provide passive income through interest payments. While the returns may be lower compared to other passive income strategies, these accounts offer a safe and stable way to grow your money over time. Royalties from intellectual property, such as patents, trademarks, or copyrights, can provide a steady stream of passive income. If you have a talent for writing, inventing, or creating, consider protecting your work and licensing it to others. This can generate ongoing income without requiring additional effort. Building passive income streams involves choosing the right strategies, making an initial investment of time and money, and managing your investments effectively. By diversifying your sources of passive income and continuing to learn and adapt, you can increase your financial security and work towards financial independence. Chapter 9: Retirement Planning, Starting Early. Retirement may seem like a distant goal, especially when you're young, but starting early is crucial for building a secure financial future. The earlier you start saving and planning for retirement, the more time your money has to grow. In this chapter, we'll discuss the importance of early retirement planning and provide practical tips to help you get started. One of the biggest advantages of starting early is the power of compound interest. Compound interest allows your investments to grow exponentially over time. By reinvesting your earnings, you can earn interest on your initial investment as well as on the accumulated interest. The longer your money is invested, the more it can grow. The first step in retirement planning is to estimate how much money you'll need in retirement. Consider your desired lifestyle, expected living expenses, healthcare costs, and any other financial goals. While it's difficult to predict exact numbers, having a rough estimate can help you set realistic savings goals. Contributing to employer-sponsored retirement plans, such as a 401k, is a great way to start saving for retirement. These plans often offer tax advantages, such as pre-tax contributions and tax-deferred growth. If your employer offers a matching contribution, try to contribute enough to get the full match. This is essentially free money that can significantly boost your retirement savings. If you don't have access to an employer-sponsored plan, consider opening an individual retirement account, IRA. Traditional IRAs offer tax-deductible contributions and tax-deferred growth, while Roth IRAs offer tax-free growth and tax-free withdrawals in retirement. Choose the type of IRA that best fits your financial situation and goals. Diversifying your retirement investments is crucial for managing risk and maximizing returns. A well-diversified portfolio might include a mix of stocks, bonds, mutual funds, and other investment vehicles. As you get closer to retirement, consider shifting to more conservative investments to protect your savings from market volatility. It's important to review and adjust your retirement plan regularly. Life circumstances and financial goals can change over time, and your plan should reflect these changes. Set aside time each year to review your retirement accounts, track your progress, and make any necessary adjustments. In addition to saving and investing, consider other ways to prepare for retirement. This might include paying off debt, building an emergency fund, and considering healthcare options. Reducing your financial obligations and having a safety net can provide peace of mind and financial security in retirement. Understanding Social Security benefits is also an important aspect of retirement planning. While Social Security may not be enough to cover all your expenses, it can provide a valuable source of income. Learn about your eligibility, estimated benefits, and the best time to start receiving benefits based on your financial situation. Another important consideration is planning for healthcare costs in retirement. Healthcare expenses can be a significant burden, so it's essential to have a plan in place. Consider options like health savings accounts, HSAs, long-term care insurance, and Medicare to help cover these costs. Finally, remember that retirement planning is a long-term commitment. Stay disciplined, continue to educate yourself, and seek professional advice if needed. By starting early and staying focused, you can build a secure and comfortable retirement. Retirement planning involves estimating your retirement needs, contributing to retirement accounts, diversifying your investments, reviewing and adjusting your plan, preparing for healthcare costs, and understanding Social Security benefits. By starting early and staying focused, you can build a secure and comfortable retirement. In summary, retirement planning is a crucial aspect of financial wellness that requires discipline, long-term thinking, and regular adjustments. By leveraging the power of compound interest, taking advantage of employer-sponsored plans and IRAs, diversifying your investments, and preparing for healthcare costs, you can set yourself up for a financially secure future. Remember, the sooner you start, the better off you'll be. Chapter 10: Protecting Your Wealth, Insurance and Emergency Funds. Protecting your wealth is just as important as building it. Unexpected events, such as accidents, illnesses, or natural disasters, can derail your financial plans if you're not prepared. In this chapter, we'll explore the importance of insurance and emergency funds as key components of financial protection. Insurance is a tool that helps mitigate financial risk. There are several types of insurance that can protect different aspects of your life. Health insurance. Health insurance helps cover medical expenses, which can be substantial. Having health insurance ensures that you can access necessary medical care without facing financial hardship. Make sure to understand your coverage, including premiums, deductibles, copayments, and out-of-pocket maximums. Auto insurance. Auto insurance is mandatory in most places and provides financial protection in case of accidents, theft, or damage to your vehicle. It typically includes liability coverage, collision coverage, and comprehensive coverage. Choose a policy that fits your needs and budget. Homeowners or renters insurance. Homeowners insurance protects your home and belongings against damage or theft. It also provides liability coverage in case someone is injured on your property. Renters insurance covers your personal belongings and provides liability coverage if you're renting. Both types of insurance are essential for protecting your assets. Life insurance. Life insurance provides financial support to your dependents in the event of your death. It's especially important if you have a family that relies on your income. There are two main types of life insurance: term life insurance, which provides coverage for a specific period, and whole life insurance, which provides lifelong coverage and includes a savings component. Choose the type and amount of coverage based on your family's needs. Disability insurance. Disability insurance replaces a portion of your income if you become unable to work due to illness or injury. This type of insurance is crucial for protecting your financial stability in case of a long-term disability. There are short-term and long-term disability policies available. Umbrella insurance. Umbrella insurance provides additional liability coverage beyond the limits of your other insurance policies. It's designed to protect you from major claims and lawsuits, offering an extra layer of financial security. In addition to insurance, having an emergency fund is essential for financial protection. An emergency fund is a savings buffer that you can use to cover unexpected expenses, such as car repairs, medical bills, or job loss. Aim to save at least 3 to 6 months' worth of living expenses in an easily accessible account, such as a high-yield savings account. Building an emergency fund takes time and discipline. Start by setting small, achievable savings goals and gradually increase the amount you save each month. Automate your savings by setting up automatic transfers from your checking account to your emergency fund. This makes saving a consistent habit and reduces the temptation to spend the money. It's important to keep your emergency fund separate from your regular savings and investment accounts. This ensures that the money is available when you need it and reduces the risk of using it for non-emergency expenses. Regularly review and update your insurance policies and emergency fund to ensure they continue to meet your needs. Life circumstances change, and your financial protection should adapt accordingly. For example, you may need to increase your life insurance coverage if you have a child or buy additional coverage for new assets. In summary, protecting your wealth involves having the right insurance coverage and building an emergency fund. Both are essential for safeguarding your financial stability and providing peace of mind. By understanding and prioritizing these aspects of financial protection, you can ensure that you're prepared for whatever life throws your way. Chapter 11: Financial Tools and Apps for Millennials. In today's digital age, there are countless tools and apps available to help you manage your finances. These tools can simplify budgeting, saving, investing, and tracking your financial goals. In this chapter, we'll explore some of the best financial tools and apps for millennials and how to use them effectively. Budgeting apps are a great starting point for managing your finances. Apps like Mint, YNAB, You Need a Budget, and Pocket Guard allow you to track your income and expenses, create budgets, and set financial goals. These apps can provide insights into your spending habits and help you identify areas where you can cut costs. Mint is a popular free budgeting app that connects to your bank accounts, credit cards, and other financial accounts. It automatically categorizes your transactions, provides an overview of your financial health, and offers personalized tips for saving money. Mint also includes features like bill reminders and credit score monitoring. YNAB, You Need a Budget, is another highly regarded budgeting app that focuses on giving every dollar a job. YNAB encourages you to be proactive with your money by assigning each dollar to a specific category, such as bills, savings, or discretionary spending. The app offers a 34-day free trial, after which it requires a subscription. Many users find that YNAB's approach to budgeting helps them gain better control over their finances. Pocket Guard is a user-friendly budgeting app that helps you see how much money you have available for spending after accounting for bills, goals, and necessities. The app connects to your financial accounts, tracks your transactions, and provides a simplified view of your finances. Pocket Guard also offers tips for reducing expenses and increasing savings. For saving and investing, consider using apps like Acorns, Stash, and Robinhood. These apps make it easy to start saving and investing, even if you have little money or experience. Acorns is an app that rounds up your everyday purchases to the nearest dollar and invests the spare change in a diversified portfolio. This set it and forget it approach allows you to grow your savings effortlessly. Acorns also offers features like retirement accounts and a checking account with cashback rewards. Stash is an investment app that combines saving and investing. Stash allows you to invest in fractional shares of stocks and ETFs with as little as $5. The app also offers educational content to help you learn about investing and build a diversified portfolio. Stash includes features like automated investing and retirement accounts. Robinhood is a commission-free trading app that allows you to buy and sell stocks, ETFs, options, and cryptocurrencies. Robinhood's user-friendly interface makes it easy for beginners to start investing. However, it's important to do your research and understand the risks before making investment decisions. For managing your credit and debt, consider using apps like Credit Karma and Debt Payoff Planner. These apps can help you monitor your credit score, track your debt, and create a plan for paying off loans and credit cards. Credit Karma is a free app that provides access to your credit scores and credit reports from 2 major credit bureaus. The app also offers personalized recommendations for improving your credit and provides alerts for any changes to your credit profile. Credit Karma includes features like credit score simulators and financial product recommendations. Debt Payoff Planner is an app designed to help you create a customized debt repayment plan. The app allows you to input your debts, interest rates, and minimum payments, and it provides a visual plan for paying off your debt. Debt Payoff Planner offers different strategies, such as the snowball and avalanche methods, to help you choose the best approach for your situation. Using financial tools and apps can simplify managing your money and help you achieve your financial goals. By leveraging these resources, you can gain better control over your finances, make informed decisions, and work towards financial success. Chapter 12: Teaching Financial Literacy. Teaching financial literacy is one of the most valuable gifts you can give to others, especially to the younger generation. Financial literacy involves understanding how money works and being able to manage it effectively. By spreading financial knowledge, you can help others make informed decisions, avoid common pitfalls, and build a secure financial future. In this chapter, we'll explore the importance of financial literacy and provide practical tips for teaching it to children, teens, and young adults. The first step in teaching financial literacy is to start early. Children can begin learning about money at a young age through simple concepts like saving and spending. For example, you can introduce the idea of saving by giving them a piggy bank and encouraging them to save a portion of their allowance or gift money. This helps them understand the value of saving and delayed gratification. As children grow older, you can introduce more complex concepts, such as budgeting and goal setting. Use real-life examples to make these concepts relatable. For instance, you can involve them in planning a family vacation by discussing the costs and creating a budget together. This helps them see how planning and saving can make goals achievable. Teens and young adults can benefit from learning about banking, credit, and debt management. Open a savings account for them and teach them how to manage it. Explain how credit cards work, including the importance of paying off the balance in full each month to avoid interest charges. Discuss the risks of debt and the impact it can have on their financial future. One effective way to teach financial literacy is through hands-on experiences. Encourage teens to get a part-time job and manage their earnings. Help them set financial goals, such as saving for a car or college, and create a plan to achieve those goals. Real-world experiences can reinforce financial concepts and build confidence in managing money. Using financial literacy resources can also enhance learning. There are many books, websites, and apps designed to teach financial principles in an engaging way. For example, apps like Greenlight and BusyKid allow children to manage their allowance, set savings goals, and learn about earning and spending money. Books like The Money Savvy Pig, by Susan Basham, and Rich Dad, Poor Dad for Teens, by Robert T. Kiyosaki can provide valuable insights for young readers. In addition to teaching financial concepts, it's important to model good financial behavior. Children and teens learn by observing the adults in their lives. Be transparent about your financial decisions and explain why you make certain choices. For example, if you're cutting back on dining out to save for a vacation, explain the reasoning behind it. This helps them understand the importance of prioritizing financial goals. Schools and educational institutions also play a crucial role in teaching financial literacy. Advocate for financial education programs in schools and support initiatives that promote financial literacy. Encourage schools to integrate financial education into the curriculum, starting from elementary school through high school. Programs like Junior Achievement and the National Endowment for Financial Education, NEFE, offer resources and curricula that can be used in classrooms. Finally, encourage a culture of open discussion about money. Many people are uncomfortable talking about finances, but breaking the taboo can lead to better financial understanding and decision-making. Create a safe environment where children, teens, and young adults feel comfortable asking questions and discussing money matters. In summary, teaching financial literacy involves starting early, using real-life examples, providing hands-on experiences, utilizing financial resources, modeling good behavior, advocating for financial education in schools, and encouraging open discussions about money. By equipping the younger generation with financial knowledge, you can empower them to make informed decisions and build a secure financial future. Chapter 13: Living Below Your Means. Living below your means is a fundamental principle of financial health. It involves spending less than you earn and avoiding lifestyle inflation, which is the tendency to increase spending as income rises. By adopting this mindset, you can save more, reduce financial stress, and work towards your long-term goals. In this chapter, we'll explore practical tips for living below your means and achieving financial stability. One of the first steps to living below your means is to create a budget. A budget helps you track your income and expenses, prioritize your spending, and identify areas where you can cut costs. Start by listing all your sources of income and categorizing your expenses into fixed, e.g., rent, utilities, and variable, e.g., groceries, entertainment, costs. Allocate a portion of your income to savings and debt repayment, and ensure that your total expenses do not exceed your income. Another key aspect of living below your means is to differentiate between needs and wants. Needs are essential expenses, such as housing, food, and healthcare, while wants are non-essential items, like dining out, entertainment, and luxury goods. By prioritizing your needs and being mindful of your wants, you can make more intentional spending decisions and avoid unnecessary expenses. Avoiding lifestyle inflation is crucial for maintaining financial stability. As your income increases, it's natural to want to upgrade your lifestyle. However, continually increasing your spending can prevent you from saving and investing for the future. Instead of succumbing to lifestyle inflation, focus on maintaining your current spending levels and directing any additional income towards your financial goals. Adopting a frugal mindset can help you live below your means without sacrificing your quality of life. Look for ways to save money on everyday expenses. For example, you can cook meals at home instead of dining out, use public transportation or carpool to save on transportation costs, and shop for discounts and sales. Small changes in your spending habits can add up to significant savings over time. Minimalism is another approach that aligns with living below your means. Minimalism is about focusing on what truly matters and eliminating unnecessary clutter from your life. By valuing experiences and relationships over material possessions, you can reduce your spending and simplify your life. Before making a purchase, ask yourself if it aligns with your values and if it will truly bring you joy. Building an emergency fund is essential for financial stability. An emergency fund provides a safety net for unexpected expenses, such as car repairs, medical bills, or job loss. Aim to save at least 3 to 6 months' worth of living expenses in an easily accessible account. Having an emergency fund can prevent you from relying on credit cards or loans in times of crisis. Using cash instead of credit can help you control your spending. When you use cash, you're more aware of how much you're spending and are less likely to make impulsive purchases. Consider using the envelope system, where you allocate cash for different spending categories and only use that cash for those expenses. This can help you stick to your budget and avoid overspending. Another effective strategy is to set financial goals and create a plan to achieve them. Having clear, achievable goals can motivate you to save more and spend less. Whether you're saving for a vacation, a new gadget, or a down payment on a house, knowing what you're working towards can help you stay focused and disciplined. In addition to these strategies, it's important to stay disciplined and avoid temptation. This may involve making lifestyle changes and being mindful of your spending habits. Surround yourself with supportive people who share your financial values and encourage you to stay on track. Living below your means involves creating a budget, differentiating between needs and wants, avoiding lifestyle inflation, adopting a frugal mindset, embracing minimalism, building an emergency fund, using cash instead of credit, setting financial goals, and staying disciplined. By following these principles, you can achieve financial stability and work towards your long-term goals. Chapter 14. The Power of Compound Interest. Compound interest is one of the most powerful tools for building wealth. It allows your money to grow exponentially over time by earning interest on both your initial investment and the accumulated interest. In this chapter, we'll explore the concept of compound interest, how it works, and strategies to make it work for you. To understand compound interest, let's start with the basics. When you invest or save money, you earn interest on your initial investment, also known as the principal. With simple interest, you earn interest only on the principal. However, with compound interest, you earn interest on both the principal and the accumulated interest. This means your money grows at an increasing rate over time. The formula for compound interest is A equals P, 1 plus R, N, caret, NT, where A is the future value of the investment, P is the principal, R is the annual interest rate, N is the number of times interest is compounded per year, and T is the number of years the money is invested. The more frequently interest is compounded, the faster your money grows. One of the key factors in maximizing the power of compound interest is time. The earlier you start investing or saving, the more time your money has to grow. Even small contributions can grow significantly over a long period. For example, if you invest $1,000 at an annual interest rate of 5%, compounded annually, after 30 years, your investment would grow to approximately $4,321. If you wait 10 years to start investing, the same $1,000 would grow to only about $2,653 in 20 years. To take full advantage of compound interest, it's important to start saving and investing as early as possible. Even if you can only afford to invest a small amount each month, the power of compounding can turn those small contributions into substantial wealth over time. Another strategy to maximize compound interest is to make regular contributions to your investment or savings account. Consistent contributions can help you build wealth steadily and take advantage of market growth. Consider setting up automatic transfers from your checking account to your investment or savings account to make saving a consistent habit. It's also important to reinvest your earnings to maximize the benefits of compound interest. Reinvesting means using your interest or dividends to buy more shares of your investment, rather than taking the money out. This allows your earnings to generate even more earnings, accelerating your wealth growth. Choosing investments with higher interest rates or returns can also boost the power of compound interest. While higher returns often come with higher risk, carefully selecting a diversified portfolio can help you achieve a balance between risk and reward. Consider a mix of stocks, bonds, mutual funds, and other investment vehicles to spread your risk and increase your potential returns. One of the best ways to benefit from compound interest is through retirement accounts, such as 401ks and IRAs. These accounts offer tax advantages that can enhance the growth of your investments. For example, contributions to a traditional 401k or IRA are tax deductible, and the investments grow tax deferred until you withdraw the money in retirement. Roth IRAs, on the other hand, offer tax-free growth and withdrawals, as long as certain conditions are met. Take advantage of employer-sponsored retirement plans, especially if your employer offers a matching contribution. Employer matches are essentially free money that can significantly boost your retirement savings. Make it a goal to contribute enough to get the full match, and increase your contributions over time as your income grows. Another key to maximizing compound interest is to avoid withdrawing your investments prematurely. Withdrawing money early can disrupt the compounding process and reduce your potential earnings. If you need to access funds, consider other sources, such as an emergency fund, to avoid tapping into your long-term investments. Understanding the impact of fees and expenses on your investments is also crucial. High fees can erode your returns and reduce the benefits of compound interest. Look for low-cost investment options, such as index funds and ETFs, which typically have lower fees than actively managed funds. Be mindful of account maintenance fees, trading fees, and expense ratios when selecting investments. In addition to these strategies, it's important to maintain a long-term perspective. The power of compound interest is best realized over extended periods. Stay focused on your financial goals and avoid making impulsive decisions based on short-term market fluctuations. Historical data shows that the stock market tends to grow over the long term, despite periodic downturns. Lastly, consider seeking advice from a financial advisor to help you create a personalized investment strategy. A financial advisor can provide valuable insights, help you navigate complex investment decisions, and ensure that your portfolio aligns with your goals and risk tolerance. In summary, the power of compound interest lies in its ability to grow your money exponentially over time. By starting early, making regular contributions, reinvesting your earnings, choosing high-return investments, taking advantage of tax-advantaged accounts, minimizing fees, and maintaining a long-term perspective, you can harness the full potential of compound interest and build substantial wealth. Chapter 15. The Power of Giving Back. Giving back is an essential aspect of financial wellness that goes beyond personal gain. It involves using your resources to make a positive impact on others and your community. In this chapter, we'll explore the importance of philanthropy, the benefits of giving, and ways to incorporate giving into your financial plan. Philanthropy can take many forms, including donating money, volunteering time, and sharing skills and knowledge. The act of giving back can create a sense of fulfillment and purpose, strengthen social connections, and improve overall well-being. Additionally, philanthropy can help address social issues, support those in need, and contribute to the greater good. One of the most significant benefits of giving back is the positive impact it can have on your mental and emotional health. Studies have shown that acts of generosity can boost happiness, reduce stress, and increase feelings of gratitude. When you give to others, it can create a sense of connection and foster a sense of community. Incorporating philanthropy into your financial plan involves setting aside a portion of your income for charitable contributions. Start by identifying causes that are important to you, such as education, healthcare, environmental conservation, or social justice. Research organizations that align with your values and have a proven track record of making a positive impact. Consider creating a charitable giving budget to ensure that your donations are intentional and sustainable. Allocate a specific percentage of your income to charitable contributions and make regular donations, whether it's monthly, quarterly, or annually. This approach allows you to plan your giving and incorporate it into your overall financial strategy. Another way to give back is by volunteering your time and skills. Volunteering can be just as valuable as monetary donations and provides an opportunity to directly engage with the causes you care about. Look for local organizations or community groups that need volunteers and consider how your skills and expertise can make a difference. Creating a donor-advised fund, DOF, is another option for structured giving. A DOF is a charitable investment account that allows you to make a tax-deductible donation and recommend grants to your favorite charities over time. This approach provides flexibility in your giving and allows you to grow your charitable contributions through investment returns. In addition to personal giving, consider involving your family in philanthropic activities. Teaching children about the importance of giving back can instill values of generosity and compassion from a young age. Encourage family discussions about charitable causes, involve children in volunteering activities, and create family giving traditions. Philanthropy can also be integrated into your professional life. Many companies offer corporate social responsibility (CSR) programs, which include matching gift programs, volunteer opportunities, and charitable partnerships. Participate in these initiatives to amplify your impact and contribute to your company's efforts to make a positive difference. Furthermore, consider the tax benefits of charitable giving. Donations to qualified charitable organizations can be tax-deductible, reducing your taxable income and potentially lowering your tax bill. Keep accurate records of your donations and consult with a tax professional to understand the specific tax implications of your charitable contributions. In summary, the power of giving back lies in its ability to create positive change, enhance personal fulfillment, and strengthen communities. By incorporating philanthropy into your financial plan, volunteering your time and skills, involving your family, and leveraging tax benefits, you can make a meaningful impact and contribute to the greater good. Giving back is not only a reflection of your values but also an investment in a better future for all. Chapter 16. Adjusting your plan for life changes. Life is full of unexpected events and changes, and your financial plan should be adaptable to accommodate these changes. Whether it's a career transition, marriage, the birth of a child, or an unforeseen emergency, being prepared to adjust your financial strategy is crucial for maintaining stability and achieving your long-term goals. In this chapter, we'll explore how to adapt your financial plan to life's various stages and challenges. One of the most significant life changes is a career transition. Whether you're switching jobs, starting a new business, or retiring, these transitions can have a substantial impact on your finances. When changing jobs, consider the financial implications, such as changes in salary, benefits, and retirement contributions. If you're starting a business, create a detailed business plan, set aside funds for startup costs, and be prepared for potential fluctuations in income. For retirement, ensure that you have a comprehensive retirement plan in place, including savings, investments, and healthcare considerations. Marriage is another major life event that requires financial adjustments. Combining finances with a partner involves open communication and planning. Discuss your financial goals, spending habits, and debt with your partner to create a shared financial plan. Consider setting joint financial goals, creating a combined budget, and establishing an emergency fund together. It's also essential to update beneficiary designations on insurance policies and retirement accounts to reflect your new marital status. The birth of a child is a joyful event that brings new financial responsibilities. Prepare for the costs associated with raising a child, including healthcare, childcare, education, and everyday expenses. Start by creating a budget that accounts for these additional costs and consider opening a savings account or investment fund for your child's future education expenses. Review your insurance coverage to ensure that your family is adequately protected, and consider creating or updating your will to include guardianship arrangements for your child. Unexpected emergencies, such as medical issues, job loss, or natural disasters, can also impact your financial stability. Having an emergency fund is crucial for weathering these challenges. Aim to save at least 3 to 6 months' worth of living expenses in an easily accessible account. Review and update your insurance coverage regularly to ensure that you have adequate protection against potential risks. Additionally, consider creating a financial contingency plan that outlines steps to take in case of an emergency, such as cutting non-essential expenses, seeking temporary employment, or accessing government assistance programs. As you navigate different life stages, it's important to review and adjust your financial plan regularly. Schedule annual financial checkups to assess your progress, update your goals, and make necessary adjustments. Life circumstances can change quickly, and staying proactive can help you stay on track and achieve your long-term objectives. In summary, adjusting your financial plan for life changes involves being prepared for career transitions, marriage, the birth of a child, unexpected emergencies, and other significant events. By maintaining open communication, creating a flexible budget, building an emergency fund, reviewing insurance coverage, and conducting regular financial checkups, you can adapt to life's challenges and maintain financial stability. Being adaptable and proactive in your financial planning will help you navigate life's ups and downs with confidence and resilience. Chapter 17. The Journey to Financial Freedom. Financial freedom is a goal many aspire to but few truly understand how to achieve. It involves having enough savings, investments, and income to support your desired lifestyle without being dependent on a paycheck. In this chapter, we'll explore what financial freedom means, steps to achieve it, and real-life stories of individuals who have successfully reached this milestone. Financial freedom is not just about having a lot of money. It's about having the freedom to make choices that align with your values and goals. It means being able to live without financial stress, pursue your passions, and take risks without worrying about money. For some, it might mean retiring early, while for others, it could be starting a business, traveling the world, or dedicating time to personal projects. The journey to financial freedom begins with setting clear, achievable goals. Define what financial freedom means to you and identify your short-term and long-term financial goals. These might include paying off debt, building an emergency fund, saving for a down payment on a house, investing for retirement, or generating passive income. Creating a comprehensive financial plan is the next step. Start by assessing your current financial situation, including your income, expenses, assets, and liabilities. Use this information to create a budget that aligns with your goals and helps you save and invest more effectively. Prioritize paying off high-interest debt, as it can significantly impact your ability to save and invest. Building multiple streams of income is a key strategy for achieving financial freedom. Diversifying your income sources can provide financial security and accelerate your journey to financial independence. Consider side hustles, freelance work, rental properties, or investments that generate passive income. The goal is to create a steady flow of income that doesn't rely solely on your primary job. Investing wisely is another crucial component of financial freedom. Start by educating yourself about different investment options, such as stocks, bonds, mutual funds, and real estate. Diversify your portfolio to spread risk and maximize returns. Consider working with a financial advisor to create an investment strategy that aligns with your goals and risk tolerance. Living below your means is essential for building wealth and achieving financial freedom. Focus on controlling your spending and avoiding lifestyle inflation. Prioritize saving and investing over unnecessary expenses. Adopting a frugal mindset can help you make intentional financial decisions that support your long-term goals. Real-life stories of financial independence can provide inspiration and practical insights. For example, consider the story of a couple who achieved financial freedom by living frugally, investing wisely, and building passive income streams through rental properties. They were able to retire early and spend their time traveling and pursuing their passions. Another example is an individual who turned a side hustle into a successful business, allowing them to achieve financial independence and create a flexible lifestyle. Regularly reviewing and adjusting your financial plan is crucial for staying on track. Life circumstances and financial markets can change, so it's important to adapt your plan as needed. Schedule annual financial checkups to assess your progress, update your goals, and make necessary adjustments. In summary, the journey to financial freedom involves setting clear goals, creating a comprehensive financial plan, building multiple streams of income, investing wisely, living below your means, and staying adaptable. By taking intentional steps and learning from the experiences of others, you can achieve financial independence and enjoy the freedom to live life on your terms. Conclusion: embracing financial well-being. As we reach the conclusion of Millennial Money Mastery, financial tips for the next generation, it's essential to reflect on the journey we've taken together. Throughout this book, we've explored various aspects of financial wellness, from budgeting and saving to investing and giving back. The goal has been to equip you with the knowledge and tools needed to achieve financial well-being and build a secure future. Financial well-being is not a destination but a continuous journey. It involves making informed decisions, staying disciplined, and adapting to life's changes. It's about creating a financial plan that aligns with your values and goals and taking intentional steps to achieve those goals. It's also about being prepared for the unexpected and maintaining flexibility in your approach. One of the key takeaways from this book is the importance of financial literacy. Understanding how money works and how to manage it effectively is the foundation of financial wellness. By continuously educating yourself and seeking out reliable resources, you can make better financial decisions and avoid common pitfalls. Another important aspect is the power of compound interest and long-term investing. Starting early, making regular contributions, and reinvesting your earnings can significantly grow your wealth over time. The sooner you begin, the more you can benefit from the exponential growth of your investments. Living below your means is a fundamental principle for building wealth and achieving financial stability. By controlling your spending, avoiding lifestyle inflation, and prioritizing saving and investing, you can create a strong financial foundation. Adopting a frugal mindset and focusing on what truly matters can help you make intentional financial decisions that support your long-term goals. The journey to financial freedom is unique for each individual. It involves setting clear goals, creating a comprehensive financial plan, building multiple streams of income, and staying adaptable. By learning from real-life examples and staying focused on your objectives, you can achieve financial independence and enjoy the freedom to live life on your terms. Giving back is an essential component of financial wellness. Philanthropy not only makes a positive impact on others in the community but also enhances your own sense of fulfillment and purpose. Incorporating charitable giving into your financial plan, volunteering your time and skills, and involving your family in philanthropic activities can create a lasting legacy of generosity and compassion. As you continue your financial journey, remember to stay proactive and regularly review and adjust your financial plan. Life circumstances and financial markets can change, so it's important to be flexible and adaptable. Stay focused on your goals, maintain a positive mindset, and seek support and guidance when needed. In conclusion, embracing financial well-being involves continuous learning, disciplined decision-making, and a commitment to your financial goals. By applying the principles and strategies discussed in this book, you can achieve financial stability, build wealth, and create a secure and fulfilling future. Remember, financial wellness is a journey, and with the right knowledge and mindset, you can navigate it successfully. Thank you for joining me on this journey, and I wish you all the best in your pursuit of financial mastery and well-being.